The bank statement is sitting on your kitchen table, still folded from the mail. You haven't opened it yet. You've been not opening it since Tuesday, which is its own kind of answer. The average household earns more right now than at any point in history, and 64% of people are still living paycheck to paycheck. You are not bad with money. You are the target of a system built with more precision than that bank statement gives it credit for. Tonight, you're going to perform an autopsy, 10 specific leaks, engineered to bleed a six-figure salary dry without you ever noticing the wound. By the end of it, you'll see the math nobody hands you in the onboarding packet. And you'll have the 10-part playbook the quietly wealthy actually use to plug it. Give the statement 10 minutes. You will open it. The math of 1995 doesn't apply anymore. Back then, a decent salary bought a house, 2 cars, and a retirement without a fight. In 2027, a decent salary often buys you a front-row seat to your own slow-motion collapse, and a very convincing feeling that you're doing fine while it happens. Most people are sleepwalking through their statements, assuming the next raise finally fixes it. It won't. You cannot out-earn a system engineered to expand its extraction faster than your income grows. Every dollar you add, it adds a new place for that dollar to quietly disappear. Stop guessing. Start auditing. 1. The number on your offer letter isn't real. You got the raise. You expected relief. Instead, you're still checking your balance before ordering dinner. $107,500 isn't $107,500. On paper, you're winning. Your parents brag about you at Thanksgiving, and you just signed a lease on a 1-bedroom in Midtown with a rooftop pool you've used twice since June. Run the audit anyway. Federal tax takes $16,100. FACA takes $8,200. State tax takes $5,400. Health insurance, a tax for the privilege of not going bankrupt if you break an ankle, takes another $6,200. Before rent even exists as a concept, $35,900 is already gone. Your 6-figure salary is a $71,600 survival budget. After $2,650 rent, you're living on roughly $2,470 a month, which is a 1998 entry-level income wearing a 2027 aesthetic and a rooftop pool you can't really justify anymore. The system depends on you spending against the $107,500 while actually living on the $71,600. That gap is where the credit card balance is born. It doesn't announce itself, it just accumulates. $60 here, $140 there, until one January statement makes you sit down. Stop the video, write down your gross pay. For tonight's audit, use 35% as a rough starting estimate. Your real number moves with your state and your filing status, but it's rarely better than that. That's your real starting line. Feel smaller yet? 2. Your car loan is quietly stealing from your retirement. The average new car payment this year is over $820. The dealership will never mention the real cost, because they're counting on your brain not doing 15 years of compounding math on a Tuesday afternoon while you're staring at a leather interior under showroom lighting designed to make the number feel smaller than it is. Finance $820 a month over 84 months at 7%, and you'll pay roughly $69,000 for a $52,000 car. Here's the forensic part. Invest that same $820 a month for those 7 years instead, and you'd have around $91,000. Leave that untouched, growing at the same 7% for 20 more years, and it becomes over $350,000. The car didn't just cost you $52,000. It also cost you roughly $350,000 in potential future wealth, quietly, in the background, while you were making payments and telling yourself the car was a reasonable decision. You're buying a $69,000 costume to look like someone who doesn't worry about money, which is exactly what makes you someone who has to. The rule that actually holds 20% down 4-year max loan, total transportation costs under 10% of take-home pay. Anything past that is a voluntary transfer of your future to a shareholder you'll never meet, in exchange for a smell that fades by month 4. You look at the Camry in your driveway. Dent in the bumper, paid off 2 years ago. Nobody compliments it, and that's exactly why you kept it. That's next. 3. Owning isn't automatically winning. Renting is throwing money away. That's the line the real estate industry has been selling for decades. At current rates, owning is often just renting from the bank with a maintenance bill attached. You open Zillow at 11:40 p.m. because everyone you know keeps telling you it's time to buy. $475,000, 5% down. In some markets, the interest alone can rival or exceed local rent early in the loan. You're building equity slowly at first, while interest, taxes, HOA, and maintenance keep arriving in full. You're a high-end tenant for the bank in the meantime, and the slow certainty that your roof and your HVAC are both going to fail on their own schedule, not yours, usually right after you've stopped budgeting for it. Pull up a 30-year amortization table, compare month 1 to month 300. If the mortgage runs past 28% of your net pay, the house owns you, not the other way around. None of this means never buy. It means stop treating the purchase like a guaranteed win just because someone at a barbecue once told you rent money disappears. Money disappears either way. The only real question is which direction it's disappearing in, and whether you actually chose that direction or just inherited it from a conversation you don't remember having. 4. The app on your phone is designed to feel like a favor. Delivery apps are not food services. They are extraction algorithms wearing a friendly icon and a 30-minute promise. A $13 sandwich becomes $23. Through the app, once you add the inflated menu price, the delivery fee, the service fee, and the tip, you feel guilty skipping because a real person is carrying it up 3 flights. That's close to an 80% markup for the privilege of not driving 9 minutes. You order twice a week, Tuesday and Sunday, without fail, because by Tuesday, you're too tired from the commute, and by Sunday, you're too tired from the week. That's the exhaustion tax. You work hard enough to afford the meal, and then you're too depleted to cook it. So you pay a premium to skip the last step. And the app knows exactly what time of night you're most likely to give in. 2 orders a week at a $16 premium each is $1,664 a year. Invest that $1,664 a year at 7%, and after 10 years, you'd have roughly $23,000, money you'd otherwise barely notice passing through your account. It's never really about the burrito. It's about the 4 minutes it takes to talk yourself out of ordering it, and whether you spend those 4 minutes or skip straight to checkout because the app made skipping them easier than not. 5. You don't own anything anymore. You rent all of it. Netflix, Hulu, HBO, Max, Spotify, iCloud storage. A chatbot subscription, Prime. They stack into a $170 a month leak nobody adds up on purpose. $170 a month is $2,040 a year to rent access to things you used to simply own. You don't even remember what half of them are for. 1 in, 1 out. Want a new service? Cancel an old one first. We're at the halfway point of this audit. 5 leaks down, 5 to go, and this is usually where a video like this starts to feel like homework instead of a warning. It isn't. The first 5 were the ones that show up on a receipt, a payment, a bill, a subscription you can point to. The next 5 are quieter than that. They're the ones that never show up as a single line item, which is exactly why they're more expensive. The statement's still sitting there on the table, still not fully open. You got as far as the top fold and stopped. Stay with it anyway. 6. High income is not the same thing as rich. There's a term for this one, Henry. High earner, not rich yet. The person making $155,000 a year who is one bad Tuesday from total collapse and looks nothing like it from the outside. The trap is lifestyle anchoring. Income goes up, and the minimum acceptable version of a car, a vacation, a bottle of wine quietly goes up right alongside it, usually before the first paycheck at the new rate even clears. You get a $22,000 raise in the spring. Within a month, you're driving a leased SUV. Because, in your own words, you deserved an upgrade. The lease alone runs $700 more a month than your old car payment. Add the higher insurance, the nicer gym you joined to match the new version of yourself, and the weekend trips that started feeling mandatory instead of optional, and your expenses rise by $23,000, almost dollar for dollar against the raise. You're now further from stable than you were before it, though your Instagram would tell you the opposite. I deserved it, you tell yourself, half laughing before anyone's even asked. Nobody's arguing. There's nothing to argue with. You're not wrong that you worked hard for it. You're just answering a different question than the one that actually matters. If you lost your income today, how many days could you actually survive? That number is your real net worth. Not the SUV, not the title on LinkedIn, the days. High earners feel the most pressure to perform wealth because everyone around them is watching for proof the raise was deserved. Wealth is actually built in the silence between what you earn and what your ego demands. If you can't be boring, you can't be rich. 7. Your employer is offering you free money and you're leaving it behind. Most people treat the 401k like a form they signed during onboarding week and never opened again. You signed yours between a laptop login and a badge photo, and you haven't looked at the percentage since. Here's the number that matters. A 4% employer match is a 100% return on that matched contribution alone the day it lands, before the market does anything at all. If your employer matches 4% and you're not taking it, you're leaving that return unclaimed. If you aren't maxing the match, you're not an employee. You're a donor. Go check the percentage right now, tonight, before you close this tab. 8. The logo is the tax. Why does a plain white t-shirt cost $380? Because you're paying to be a walking sign for someone else's billion-dollar company, and they didn't even have to pay you for the ad space. A $1,100 hoodie and a $38 blank one have identical utility. The $1,062 gap is what you pay to signal to strangers who will forget your face in an hour that you have money to waste. The people actually winning don't have the logos. They have the stealth instinct. They drive the same paid-off sedan for 11 years while the account behind it quietly generates more in a bad month than the hoodie cost. Run a cost per wear on your own closet sometime. A $480 jacket worn twice a season is $240 a wear. That's not style. That's a costume with a subscription fee, renewed every winter without you ever signing anything. Nobody at the dinner table can see a brokerage statement. They can see a logo. That's the entire business model, and it's a very good one, for everyone except the person wearing it. 9. $0 in the bank is a cognitive tax, not just a financial one. Financial stress isn't only a budget problem, it's a processing problem. At 0, your brain switches into survival mode and stops making long-range decisions because it's too occupied solving how $24 stretches to Friday. You know exactly what that loop feels like because you've lived some version of it yourself. Your coworker Denise is living in it right now. She's 31, makes $61,000, and last month her card got declined at the grocery store checkout. Not maxed out dramatically, just $40 over, on a Tuesday, in front of the guy from accounting who was next in line. She laughed it off, put back the rotisserie chicken, paid for the rest. She told you about it Thursday like it was funny. It wasn't funny. You could see it in how fast she said it. Like she needed to get the sentence out before it turned into something else. A $5,000 or $10,000 buffer can buy something. A paycheck can't. Time to think. The system profits from the scramble. It's counting on you needing the 24% credit card the day the tire blows or the dog needs the vet at the worst possible hour with no time to shop around. For a lot of people, $10,000 is where the feeling starts to change. Past that number, you stop being prey in the transaction and start being the one reading the fine print. You can wait for the right thing. You can say no. There's a version of you from a few years back who would have laughed at that number. $10,000 sitting untouched, doing nothing, when it could be working somewhere flashier. That version of you didn't understand yet that the buffer isn't idle. It's the thing that would have let Denise put the chicken back because she wanted to, not because $40 decided it for her. 10. The only fix that survives a bad week is one you never have to remember. How do you actually stop the bleeding? You automate it because willpower runs out by 3 p.m. on a Wednesday, and a system doesn't get tired. 3 moves. The split. Pick a percentage you can actually sustain and automate it before the money ever touches checking. For this example, use 20%. The sweep. Every Sunday night, whatever sits above your $1,000 baseline moves automatically, no deliberation. The index. One low-cost total market fund. Left alone. Stop trying to find the next hot stock. That's the entire design. It's supposed to be boring enough to forget about. Because forgetting about it is exactly what lets it work. None of these 10 things are evil on their own. A car isn't evil. A hoodie isn't evil. They're tools. Right now, for most people, the tools are being used on them instead of by them. You text Monica the next morning, not the numbers, not a lecture, just coffee Sunday? I want to show you something. She writes back a single question mark, then 10 minutes later, yes. You don't know yet if she'll actually sit with the spreadsheet or just nod politely and order another latte. That's not really your decision to make. You can only open your own statement first. If any of this made you angry, good. Anger is the first 10 seconds of an audit. What you do with the next 10 years is the rest of it. You finally open the bank statement on the kitchen table. It's not as bad as you built it up to be in your head. It never actually is. Once you stop avoiding it and just look. You get a pen, you start with line 1, and then line 2, and the number at the bottom stops being a verdict and starts being a starting point. You can spend the next decade looking successful, or you can spend it becoming stable. Most people don't find out until much later that those were never the same thing.